Hello and welcome back to Upgrade Your Life. In the dynamic world economy, inflation is a key factor that influences the purchasing power of money and the overall health of an economy. While high inflation can erode the value of money, too low inflation or deflation can lead to reduced economic activity. Central banks around the globe monitor and manage inflation to ensure it stays within a desirable range to foster economic growth and stability. However, some countries have been particularly successful in maintaining low inflation rates. Let's delve into the nations with the lowest inflation rates in the world, understanding how their unique economic conditions, policy decisions, and strategic advantages have contributed to these remarkably low figures. China. China's low inflation rate 2023 results from weak domestic demand, a subdued labor market, and cautious consumer spending. Consumers have been reluctant to spend in the face of economic uncertainties, leading to a lack of upward pressure on prices. The People's Bank of China's monetary policies, such as controlling interest rates and the money supply, have also played a crucial role in maintaining price stability. Other factors contributing to low inflation include a large labor supply that controls wage growth, technological advancements reducing production costs, stable global commodity prices, and a relatively stable exchange rate for the yuan. Despite first-quarter solid results, China's GDP growth forecast for 2023 remains at 5.5% due to the same economic challenges. In the insurance sector, uncertainty about income has increased demand for savings-type products and slowed the growth of risk protection solutions. Brunei Darussalam, a small but wealthy country with an economy worth $18.4 billion and a high GDP per capita, reported a low overall inflation rate of 0.2% in May 2023, despite a relatively high food inflation of 2.8%. This low inflation can be attributed to effective regulation by the Brunei Monetary Authority, economic stability due to oil and gas exports, and the country's small population leading to lower consumer demand. Government subsidies on essential goods and services also lower the cost of living. Additionally, the pegging of the Brunei dollar to the Singapore dollar at a 1-to-1 ratio offers exchange rate stability, aiding in maintaining steady price levels and controlling inflation. Panama. From January to May 2023, Panama saw an overall inflation rate of 1.5%, with a notably low inflation rate of 0.2% in May. However, there were significant price increases in some segments of the Consumer Price Index, with a sharp rise in housing and utilities prices, 10.9%, and food and alcohol prices, 4.2%. Despite this, Panama maintains low overall inflation due to several factors: its use of the US dollar, which limits money printing, its rapidly growing service-based economy, trade dynamics due to its major shipping route, self-sustainability in food and abundant hydroelectric power, and regulated prices for some goods and services. Thailand, a major global tourism hub and exporter of agricultural and manufactured goods, reported a 21-month low inflation rate of 0.53% in May 2023. This low inflation rate can be attributed to several factors. The significant income from tourism helps maintain economic stability and control inflation. Earnings from major exports, such as rice, sugar, and various manufactured products, also contribute to stabilizing foreign exchange earnings and managing inflation. Moreover, the Thai government enforces strict monetary policies, with the Central Bank of Thailand playing a crucial role in determining interest rates and controlling the money supply. Domestic competition, especially in the retail sector, keeps prices low, thus assisting in keeping inflation low. Additionally, as an energy exporter, Thailand benefits from stable energy prices which further help in maintaining low inflation. Costa Rica, valued at $68 billion and with a GDP per capita of $13,090, reported an annual inflation rate of 0.88% in May 2023 and negative inflation of 1.36% for the year ending in March 2023. The low inflation rate is due to several factors: a diversified economy encompassing industrial manufacturing, agriculture, tourism, and services, which reduces vulnerability to price fluctuations, the central bank's monetary policies aimed at price stability, a stable political environment promoting economic stability, and a managed floating exchange rate system, which allows the currency to adjust to market forces and mitigates inflationary pressures from international currency market fluctuations. Oman. The Sultanate of Oman, with a GDP of $110 billion and a relatively high GDP per capita of $23,416, maintains a low inflation rate of 0.91%. The low inflation is attributed to several factors: heavy reliance on stable oil and gas exports for economic stability, government subsidies on various goods and services that control price rises, the pegging of the Omani rial to the US dollar ensuring exchange rate stability, and limiting import price inflation, effective monetary policies by the Central Bank of Oman to manage money supply and control inflation, and the suppression of inflation by stable or low international commodity prices as Oman imports many goods. Armenia, a small, landlocked Asian country with an economy worth $23.7 billion, records a low inflation rate of 1.3%. This low rate is attributable to several factors. The nation's diverse economy with strong services, food processing, and mining industries helps to cushion inflationary pressures. The Central Bank of Armenia's mandate to ensure price stability through the use of monetary policy tools like interest rates and reserve requirements, a managed float exchange rate policy that helps control import price inflation, disciplined fiscal policies maintained by the Armenian government, and low or stable global commodity prices which suppress inflation as Armenia relies heavily on imports. Burkina Faso, a West African country with an $18 billion economy, maintains a low inflation rate of 1.5% due to various reasons. Its largely agricultural economy, with the majority of the population involved in subsistence farming, leads to stable internal prices. As a member of the West African Economic and Monetary Union, the country benefits from price stability maintained by the Central Bank of West African states. The government's fiscal discipline in enhancing domestic resource mobilization and controlling public expenditure also contributes to low inflation. Additionally, the economy gains stability from the inflow of foreign aid and remittances. Stable global commodity prices, especially for goods imported by Burkina Faso, further help keep inflation low. Georgia, a country located between Europe and Asia, reported a moderate inflation rate of 1.5% in May, with an annual rate expected around 3%. The control of inflation can be attributed to the National Bank of Georgia's proactive inflation targeting regime, which stabilizes prices by adjusting policy rates. The country's diversified economy, encompassing services, agriculture, and industry, mitigates sector-specific shocks, thus aiding in price stability. Further contributing factors include the stable exchange rate of the Georgian lari against major currencies, the government's prudent fiscal policies, weak or slow-growing domestic demand, and stable or decreasing global commodity prices, particularly for imported goods. Seychelles. The Central Bank of Seychelles has maintained the monetary policy rate at 2% for the third quarter of 2023, thanks to a strong rupee leading to declining local inflation. As of May 2023, the year-on-year inflation had decreased by 1.0%, with an average rate of 1.8% over 12 months. Prices have fallen due to decreases in non-food commodities, including a 1.4% drop in electricity prices, a 4.7% decrease in transportation costs, and a 1% drop in communication expenses. The CBS governor highlighted that the US dollar's decreasing price has made it less expensive to purchase, positively affecting the economy. Additionally, a robust tourism sector has supported the economy, even though tourism earnings have reduced due to a decline in average yield per visitor. The CBS governor noted the need to continuously monitor global economic developments, especially in countries key to the tourism sector, due to potential negative impacts such as economic slowdowns or recessions. Jordan. The Hashemite Kingdom of Jordan, a Western Asian country, reported an inflation rate of 1.96% in May 2023, with notable increases in the sectors of rent and transportation. The inflation dynamics in Jordan can be attributed to increased demand in these sectors, potentially driven by population growth, urbanization, and economic activity. Furthermore, Jordan's dependence on imports, especially energy, means that rises in international oil prices can escalate transportation costs, causing higher inflation. Monetary policy by the Central Bank of Jordan, including changes in the money supply, also influences inflation rates. The exchange rate of the Jordanian dinar impacts the cost of imported goods, with a weaker dinar potentially increasing inflation by making imports pricier. Government policies, such as changes in subsidies or price controls, and any supply constraints or inefficiencies in the rental or transportation markets, can also drive up prices. Fiji. The Republic of Fiji, a Pacific Ocean island country, experienced a decline in inflationary pressures from 4.7% a year ago to 2% in March 2023. Several factors may explain this downward trend. Firstly, post-COVID-19 recovery inflation might have eased as economies normalized. Secondly, the Reserve Bank of Fiji could have deployed anti-inflationary measures, like interest rate hikes or money supply reductions. Thirdly, Fiji's heavy reliance on imports means that global price fluctuations or exchange rate changes can greatly impact its inflation rate. Additionally, a decrease in global energy prices could have contributed to lower inflation, given Fiji's significant dependence on imported energy. Decreased demand or increased supply of goods and services within Fiji's economy could have also contributed to the reduced inflation. Finally, any new fiscal measures or policies implemented by the Fijian government, such as public spending reductions, debt control, or tax policy adjustments, can have an impact on inflation rates. Bahrain. The Kingdom of Bahrain, an island nation boasting a $44 billion economy, maintains a relatively moderate inflation rate of 2.2% due to several key reasons. Bahrain's diversified economy, focusing on finance, manufacturing, and tourism, helps create a balanced economic landscape, reducing inflationary pressures. The nation's central bank effectively manages inflation using monetary policy tools such as interest rate adjustments and money supply control. The Bahraini government promotes price stability, particularly for essential goods and services, aiding in inflation control. The pegging of Bahrain's currency to the US dollar contributes to maintaining stable import prices and reducing inflation. Furthermore, Bahrain's open economy and the stability or decrease in international prices can lead to lower inflation rates. The government also employs subsidies and price controls in certain sectors to avoid sudden price increases and manage living costs. Liechtenstein. The Principality of Liechtenstein, one of the smallest nations worldwide, enjoys a robust economy with the highest GDP per capita at $180,000. This prosperity corresponds to a moderate inflation rate of 2.2% due to several influences. The thriving economy, driven by industrial, financial, and service sectors, often results in well-controlled inflation. Liechtenstein's monetary policy, relying on the Swiss franc and the Swiss National Bank's regulations, effectively manages inflation. As most goods and services are imported due to its small internal market, Liechtenstein's inflation is closely tied to its trading partners, especially Switzerland and the European Union. The nation's strong fiscal policy maintains a balanced budget, curbing excessive public spending which could incite inflation. Furthermore, high per capita income typically aligns with increased savings, further moderating inflation. The high degree of political stability in Liechtenstein enables the maintenance of consistent economic policies, thereby contributing to price stability. Switzerland. Switzerland's inflation rate was 2.2% in May, the lowest since February 2022, primarily due to reduced prices for food, housing, and transport. While higher than the central bank's target, it's still low compared to the 6.1% in the euro area. Factors contributing to this include Switzerland's minimal reliance on fossil fuels, strong franc, low inflation expectations, and moderate wage growth. The composition of Switzerland's consumer price index basket also plays a role, especially the low increase in energy prices due to reliance on hydroelectric and nuclear power. These elements ease the pressure on the Swiss National Bank to adjust monetary policy. Conversely, the European Central Bank may face challenges if high inflation persists. The energy crisis caused by Russia's invasion of Ukraine highlights the importance of energy security and efficiency. Russia. As of May 20, 2023, the inflation rate in Russia stands at 2.24%, below the Central Bank of Russia's target of 4%. This drop in inflation is due to the country's recovery from war and economic sanctions which led to a severe recession. However, the CBR anticipates inflation rates to rise due to factors like increased government spending, wage increases driven by a tight labor market, and potential currency depreciation. In response to this, the CBR has maintained its key rate at 7.5%. Improved economic conditions, characterized by a recovery in imports, increased domestic production, and a stronger ruble, have helped reduce inflation. However, these gains may be offset in the future by higher government spending and a reduced labor force. Vietnam. Inflation in Vietnam decreased to 2.4% in May 2023, the lowest rate since March 2022, down from 2.8% in April. This decline in inflation was primarily due to a significant drop in transport prices, although housing costs increased. Despite these changes, the annual average inflation remained steady at 3.7%. Consumer prices saw a slight increase of 0.01% in May over the previous month, in contrast to the 0.34% decrease recorded in April. The Economist Intelligence Unit analysts predict a more rapid easing of inflation in the second half of 2023 due to falling global energy prices and a higher base from the previous year. However, potential disruption to food supply caused by the El Niño weather phenomenon could place upward pressure on inflation, but the impact will likely be limited due to high rice stocks and surpluses of other crops. Ecuador. The inflation rate in the Republic of Ecuador, a South American country with a $115 billion economy, is low at 2.5% due to various factors. These include Ecuador's dollarization in 2000, which prevents excessive money printing and links the country to the U.S.'s monetary policy. Low global oil prices also reduce domestic production and transport costs. A strong dollar can lower import prices, while the government's fiscal policies, such as subsidy programs and price controls, also help contain inflation. Furthermore, the COVID-19-induced economic contraction has reduced demand and downward pressure on prices. A moderate economic recovery is also less likely to generate significant inflationary pressures. Saudi Arabia. The Kingdom of Saudi Arabia, as the world's largest oil exporter, benefits from substantial oil revenues, known as petrodollars, which play a crucial role in stabilizing the economy and mitigating economic turmoil. These petrodollars enable the government to manage fiscal policies, maintain currency stability, and invest in various sectors of the economy, leading to overall economic stability and moderate inflation rates. As a result, Saudi Arabia's latest inflation estimate stands at 2.8%. Denmark. Denmark's latest inflation estimate is 2.9%, showing a decline from 5.3% in April. The drop in inflation can be attributed to a decrease in electricity prices. The efficient management of energy costs and a strong economy likely contributed to the moderation of inflation in Denmark. As a prosperous Nordic European nation, Denmark maintains stable economic conditions that help control inflationary pressures and maintain a relatively moderate inflation rate. If you found this information helpful and interesting, please consider giving it a like and sharing it with your friends and colleagues. And don't forget to subscribe to stay updated on more insights and analyses like these. Your support greatly encourages us to continue delivering quality content. Thank you.